What's up everybody, and welcome to another video. And in this video we're going to be going over the least amount of money you need to be invested in to have your dividends pay for your lifestyle, which is the dream come true. We're going to be doing this. We created a portfolio with 4 different ETFs that I believe have big upside potential, and I will actually be buying some shares in these ETFs because I believe the dividend yield and the risk to reward ratio and the past performance is too good to be true. I've looked into everything. These ETFs make a ton of sense. So before I go any further, all I said, if you do enjoy this video, you make sure to give this one a thumbs up and you subscribe. You turn on post notifications for videos that are coming out every other day. I'm trying to provide as much value as I can, sharing my funds with you, sharing when I buy or sell a stock, what's in my portfolio, my dividend portfolio. So let's stop wasting time and get into the video. So you came here to figure out what is the least amount of money that you need to live off of dividends. So in this, I went through 4 different calculations. I went through a calculation with if you just spent, like a single person spending $2,000 per month, being very frugal with their money, $24,000 annually, and then we've got the monthly average coming in at, which is $3,189 a month, $38,266 annually, which is the monthly expenses for one person. And then we went through a calculation of $5,000 a month, and then a calculation of $7,500 per month. We're going to be using this fund, for example, but you can use whatever fund you'd like. It just depends on your dividend yield, everything like that. But whenever you go to see on articles, you go look on how much online, how much do I need to live off of dividend income? It's going to mainly tell you $1 million, $2.5 million. You know, sometimes it'll say $750,000. That's with the 4% dividend yield, or maybe you need $2 million with a 2% dividend yield. Now, the numbers we came up with today are a lot smaller than these numbers. Now, depending on how much you spend and what your tax bracket is, it's going to be very different. So what we're going to be doing is defining like what's the difference between ordinary dividends and qualified dividends. Because when you get taxed, if your stock is just an ordinary dividend, meaning you have not held it for that long, like maybe less than 2 months, then you're going to be taxed as ordinary income. It's going to be in your tax bracket, okay? But if you have a qualified dividend, which is long-term holding, it's going to be capital gains. You'll be taxed either 20%, 15%, or a 0% rate. The government likes people to buy and hold stocks. They don't like to see selling. So if you just hold these dividends long-term, this whole thing was literally designed for long-term. The tax cut was designed to reward patient long-term shareholders. So you have to hold them for more than 60 days during the 121-day period, yada yada. Don't make your head spin. Pretty much, if you held the stock for a few months, you're going to get the qualified rate. Here is the tax rate for these qualified dividends. You've got 0% if you make up to $40,000 and $400 per year and you're single. If you're married and filing jointly, you're making $80,800. You can see this. I'm not going to go through it all, but these are the tax rate that you get for qualified dividend taxes, which is 90% of what you're going to be paying. Maybe not the first time you get the dividend, but once you just hold in your portfolio for more than like 2 months, you'll be chilling and you will be paying ordinary qualified dividend tax rate, not ordinary. But let's talk about these ETFs that we talked about in this fund. So what we did is we split this fund into 4 slices, 25% each target. Now you can add, remove, put in different funds, whatever you like. But these are 4 ETFs that I believe have a lot of potential and potentially, in my personal opinion, not financial advice, deserve a spot in your portfolio. So first up, we have QYLD, and then we got XYLD, JEPI, and NUSI. These are all kind of covered call premium income ETFs, meaning that they write options, collect premium, and then they use this premium to pay their shareholders back in dividends. And these are catching a lot of attention for dividend shareholders. So let's talk about the first one, which is QYLD, Globalx funds, Globalx Nasdaq 100 covered call ETF. They take stocks in the Nasdaq 100, sell covered calls on them, make premium. You can see right here, it says their dividend yield right now is 10.42%, which is very, very solid. Over the past year, they're up 5.5%, and year to date, they're down 0.7%. However, that dividend yield is carrying them through with about a 9.5% return whenever you just do the math. Now, this ETF originated in pretty much 2013, and on its all-time, it is down 9.51%. And a lot of people might look at this and be like, automatic red flag, I will not be investing in this ETF, in this stock, etc. Now, depending on it, usually I myself am like, hey, I don't want to invest in something that's going to lose value. But it's a difference whenever it's an ETF and a stock. If a stock is continuously losing value, the company sucks, I'm staying away. I don't care. Like, I'm not touching the stock. Okay? However, the dividend yield is actually paying incredible rates and sustaining these considerably, like, all the way over time. We can go look on these dividends real quick. Just look at the dividend history. Okay? These numbers are incredible. Check this out. They always pay these dividends. Now, they are going to be very stagnated because of the simple fact that you can't really tell like how much premium you can be making, as you can consistently tell a company, here's how much revenue we expect to make. So whenever you do the calculations on Xyld, you assume, these are assuming a $10,000 initial investment, and it will show reinvested dividends. What do you get? If you started investing on Xyld, when this ETF started in 2013 and you ended this Friday, October 22nd, you would have a share price of $25.02. However, you would end at $22.64. But with your reinvested dividends, your starting shares would be at just below 400 shares. You would end with more than 100% the amount of shares you have at 883 shares. This is you not putting in another penny after you invested in them when they started. Just reinvested dividends alone, you put $10,000 in, your ending value is $19,993. You collected $11,166 in dividend income. In just that 8-year period, not even. Just below 8-year period. Okay, total return 99.94%, annualized 9.22%. Very, very solid returns. And what I like is that these are actually guaranteed returns. They're not unrealized gains. They're realized gains, and that money is sitting in your account. And now you have 883 shares that you only paid for 399 shares, and your yield on cost is just going and going and going. It keeps getting better and better and better. But let's talk about the next ETF, which is Xyld, Globalx S&P 500 covered call ETF. So they take stocks from the S&P 500 and sell covered calls. They currently have a dividend yield of 9.19%. Past year, we're up 12.44%. Year to date, up 8.19%. I love this ETF. An expense ratio of 0.6%. And I did forget to mention earlier in the video, every single ETF we're looking at is paying these dividends on a monthly basis. Incredible stuff. Xyld, maximum, they're up 24.10% since they were initiated back in 2013. So ETF, share price appreciation, great. Makes the check. Dividends, makes the check. What are your calculations on Xyld? If you invested when they started and then sold last Thursday, October 21st, I believe that was last Thursday. Yeah, last Thursday, October 21st, you'll see you would have started with 247 shares and ended with 396. Your investment would be up 99.29%. You would have collected $7,038 in dividends in just an 8.31 year period. So annualized return is 8.65% year over year, which is incredible, incredible gains. Now, let's talk about JP Morgan. Okay, what we're seeing right here is the JP Morgan Equity Premium Income ETF. What you'll see is monthly dividend yields of 7.27%, past year up 15.23%, year to date 11.28%. JEPI is a little bit of a newer ETF. They were initiated in 2020, and you can see maximum they're up 23.86%. Looking on these calculations, you would, in just a 1.4 year time period, you would have an annualized return of about 25.35%, total return of 37.72%. If you invested when they were initiated, you would be sitting on 23 more shares than you had initially, and your investment would be up from 13,000, so you'd be up $3,772 with $1,300 collected in just a year and a half. Not even. Last ETF we'll look at before we will look at these numbers of how much money you actually need is NUSI ETF Series Solutions Nationwide Risk Managed Income ETF, sitting in with a whopping dividend yield of 7.77%, monthly dividends, expense ratio of 0.68%, up 4.6% over the past year and 0.84% year to date. Maximum wise, what we'll see is that NUSI is up 10.26% from their initiation date in 2019, a little volatile, but looking on the calculations, if you start with $10,000 invested when they first started, you would be sitting on $12,841. That's a 28% total return, 14.58% annualized. That gives you 397 shares that you started with, and now you're sitting on 461 shares. That is the power of dividend reinvestment. You're literally getting paid to invest. You're getting paid to make more money, and you got to take advantage and capitalize on opportunities like that. Now, let's talk about the numbers and the good stuff that we want to see. We are taking our dividend calculations from this pie, just taking 25% on each ETF. We have a dividend yield of 8.542%, an expense ratio of 0.43%, which gives us a net yield of 8.112%. So, assuming your expenses are $2,000 a month or $24,000 a year, you need a portfolio value of $295,000, $857.99. How am I getting these numbers? Here is how you calculate this. So you want your goal, you want your portfolio value. That is going to equal your goal income, your goal expenses, whatever that might be, so however much you're spending on an annual basis. Okay, this is an annual number, divided by your dividend yield as a percentage. So we have an 8.112% dividend yield. What you do it is you take it as a decimal, not a percentage. Sorry about that. So you take it like this: $38,000, $266. Okay, divided by 0.08112. What you do is you just take that decimal and you move it 2 to the left. Okay, 0.08112. You calculate that. That gives you $471,720.91. That's the same number that we see right here. If you're assuming your expenses were that much per year, that's the portfolio value you need, assuming that your dividend yield will be this, and that continue to pay these dividends consistently. And this does not even include share price appreciation. And whenever you're investing these dividends, these numbers are just going to increase and increase and increase, making it absolutely incredible gains. Now, if you want to be spending $60,000 a year, you're going to be needing $739,644.97. And assuming expenses of $90,000 a year, you're going to need $1,199,467.46 for your portfolio. But remember, if you just continue to reinvest those dividends for a little bit longer, and I know that you might be looking at these numbers and might be like, I don't have this much money. You kind of have two choices, and I hate to be like, I don't want to sound like the bearer of bad news, but you have two choices. One, you can either complain and be like, oh, I'll never get there, I can't do it. Or you can, two, take action, literally just invest as little as you can. It gets you a little bit closer every single day. Get 1% better every day, and just keep pushing, keep pursuing, being persistent, just going through with it. Whether you just have to believe, you kind of have to believe in yourself that you can get to these numbers and that you can consistently do it. Cut expenses that you don't need. Do everything that you can. Start something else. Start working a little bit harder and just make a little bit more. Put a little bit into these ETFs, into these stocks, and slowly over time, you'd be glad that you did it rather than you complained, because nobody got anywhere by complaining. But that is what I have for you guys in this video. So if you did enjoy it, make sure to subscribe to the channel. Turn on post notifications so you don't miss out on any future videos. I'm trying to provide as much value as I possibly can. Thank you so much for making it to the end of the video. Check out the links in the comments or description below for some free stocks, free money, and check out the ETFs and the portfolios that I've built. Again, thank you. Check out my Instagram. Follow me on there, posting 2 times a day on there. Thank you so much, and I'll see you at the next video.